Peter Schiff, the author of the brand new book, How an Economy Grows and Why It Crashes. He's not as optimistic for next year either. Peter, thank you for joining us. Walk us through what you expect to see in 2014.
Well, I think if the Fed does taper, the only way we're going to get a rally is if they undo the taper and start doing more QE. I don't expect Janet Yellen to taper at all. I expect her to continue to talk about it, but not do it. I think investors are really underestimating the severity of the problems that underlie the structure of the U.S. economy and the degree to which the Fed is masking and actually exacerbating those problems with QE. And so I think we're going to get more QE, but it's not necessarily that bullish for the stock market. It will prevent the bear market that would otherwise take place, but I think it will cause investors to look more overseas, maybe some of the markets that they've been ignoring as they've been tripping over each other to buy U.S. stocks, so I think are pretty expensive.
Brian, you want to respond to that?
Well, I agree to part of that. The part that we agree with is that we think the tapering could be held off a little bit longer than most people think. I mean, this tapering situation is going to be all about the economy recovering and, quite frankly, employment. We don't think we get a good picture on that until the end of the first quarter at the very earliest. With respect to growth elsewhere, we think that was the last cycle trade. The next cycle is going to be about cash and stability. The last cycle was about credit and leverage. Now these emerging markets in Europe are going to be delevering for the next 10 years, and the U.S. is already done that. And so we think the biggest surprise of all, Kelly, is that the U.S. puts forth another strong year just in terms of positive performance relative to the rest of the world. And I think that would surprise most people.
In terms of the stock market or in terms of GDP?
I just don't know how you say the U.S. is delevered. We've got more debt than ever at the government level, at the corporate level, at the individual level. We are loaded up with debt. All of this deleveraging is a myth. The only thing keeping us afloat is 0% interest rates and QE.
And, Peter, it's done a pretty good job at that. So here's what I wonder. If a lot of people agree with you or sympathize with the idea that this all ends badly at some point, it's still a very different thing from saying it will end badly next year. So what are your recommendations for people who are looking, with their portfolios at maximizing their return next year?
Well, hardly anybody agrees with me that it's going to end badly. That's the problem. Most people think it's going to end well. That's why they're making all the mistakes that they're making, and that's why they're ignoring buying things like gold. I mean, you're mentioning that gold is starting off the month lousy. It's been a lousy year for gold because so many investors incorrectly perceive a recovery that doesn't exist. They think that we're deleveraging. We're piling on more leverage than ever before.
Peter, what are your recommendations
I think that investors have to ignore what everybody is buying that doesn't understand the fundamentals and look to what everybody is overlooking.
Such as?
Well, I mentioned in gold, but I think that you can be in some of these emerging markets or foreign stock markets that will benefit from the weakness that is going to come in the U.S. dollar. People are expecting the dollar to rally because they believe the Fed is going to tighten, that we have a recovery. When they wake up to the reality of a faltering economy and more QE, the dollar will weaken, and I think that is going to attract a lot of money to some of these foreign markets. At the same time, it's going to undermine the phony U.S. recovery because a weak dollar is going to put even more upward pressure on consumer prices. It'll make it hard for the Fed to pretend there's no inflation, and it's going to put more pressure on the long end of the bond market, meaning the Fed's going to have to print even more money to keep interest rates from rising, or it's going to let them rise, and that's just going to add more problems to the economy.
Brian, a quick response?
Well, I would say that corporate balance sheets are the strongest since the 1950s, so clearly corporate America is delevered. There's three legs of the stool. There's corporate America, consumer America, where they're cutting up their credit cards and starting to deliver, and the government. The government's the easy answer on leverage. That's easy. But I would caution people to continue the same cycle trade led us down this path between 2000 and 2010. That's not going to lead global markets from here. And so I'd be just very nervous about dipping our toe again in emerging markets in Europe.
That, by the way, emerging markets
emerging markets haven't been the leaders.
And not just between the two of you. So I think it's a theme we'll have to come back to. Peter, Brian, thank you.